So the topic today is bank-owned life insurance, also known as BOLI. So what we're going to look at is a specific case study in which a bank is presently considering a new purchase. When you hear the word purchase with a bank-owned life insurance policy, the purchase is the initial deposit. So we're going to see how much the bank is considering depositing into a cash value life insurance policy. You'll see that the range is anywhere between $2 and $5 million. However, when we look at this case study, what we're going to look at very, very closely is the cash value, how it performs, and then why it's performing in the way that is illustrated. So to begin, what we've got is a new purchase, which again is the initial deposit. The bank considered options initially of $2, $3, and $5 million. What we'll focus on in this example is the $5 million purchase. They considered a number of different companies. We initially showed 4 different life insurance carriers. Now there's a lot that goes into the life insurance company selection with a BOLI purchase. One, there are limits these are regulated that determines how much bank-owned life insurance can be purchased from a bank with one particular life insurance company, and also the total amount of bank-owned life insurance that can be purchased. But when it comes to company selection, and particularly looking at illustrations, what we've got are 2 things. We've got the current crediting rate, which is the gross crediting rate an insurance company is applying to a BOLI product, and then you also have the guaranteed crediting rate. Now, what I like to hit on here with the guaranteed crediting rate is I actually prefer to look at the guaranteed values. And here's why. One, it's typically what we will see on an illustration. However, the guaranteed values, one, assume the guaranteed crediting rate, but it also assumes that the insurance company is going to assess the maximum allowable charge with that bank-owned life insurance product. So when we look at the internal expenses and we're looking at the guaranteed values, you'll see an absolute worst case scenario as the company is illustrating the highest charge for those expenses they legally can, combined with the guaranteed minimum crediting rate. How do you think those values will look? Not that good, but it is good to look at. So how the cash value functions when we look at a BOLI illustration is as follows. The illustrations will always display to you, the consumer, if you're a bank, a decreasing growth rate, meaning year over year, when you look at that annualized return, the annual internal rate of return in the example you're about to see, it'll be less and less. For example, the first year, maybe 4%. Then it's 3.95. Many years later, it's 3.3%. And we see it gradually decline over time. The question often comes up, why? So let's take a look at that. Here is an example of one of the life insurance illustrations. And what do you notice here? Company A, we've got the current crediting rate. So these are the non-guaranteed values. Here's our annual internal rate of return, what the policy is growing by each year net. We see the first year, $5 million deposit is made. Cash value is $5.2 million. There's the initial death benefit, $19 million and change. Net growth rate, 4.32%. What we see is for the first 3 years, it's at that 4.32%. But then what happens as the years pass? That annual growth rate gradually declines over time. The reason why is because when we look at the product itself, what we have is as follows. Let's do it this way. Here's our life insurance policy, a little chart. We've got our initial premium. Let's put this in blue. Let's call it a deposit. The bank deposits $5 million. Now, when we draw this out with a whole life insurance product, typically the cash value starts lower, less than the $5 million. In this case, we want to put it above. And the reason why, because in the first year, we've got more than $5 million. So this starts out higher, and we see it increasing over time. Now, what results in this? I'm still going up. Like if we look at this in dollars, let's look at year 20, for example, 20 to 21, you're at 8.8. Now you're at just about $9 million. So you do see cash value growth there. However, the actual growth rate year over year was not as attractive. So what's slowing us down is this COI, which is short for cost of insurance. So what happens here, every year, as the insured grows older, or multiple insureds with a BOLI purchase, typically it's on a number of employees or officers, those expenses gradually increase. So what we've got going on here is when we have an illustration, this is going to show a gross rate that is constant. It's not increasing over time, but the insurance expenses are. So to oversimplify, if you have a life insurance policy or any product where we've got growth, let's say it's growing by 4% every year, but then we start to deduct fees, or in this case, the cost of insurance that starts out at 0.5%, then it turns into 1%, then it turns into 2%. Up here in black, you've got your gross. But then let's put our net in blue, which you can subtract percentage here. And what would you have? 3.5% and 3%. See what's happening? 4 minus 2 is 2%. So that's what's going on in this case. If the rate increased over time, what would happen? Well, my net would be higher. What if the rate goes down? My net would be lower. But the reason we see those internal rates of return decreasing here is because we have a constant crediting rate, but an increasing cost of insurance. Pretty interesting. We can look at the same thing here with the guarantees. If you like to look at things very, very conservatively, here you go. $5 million deposit. This is with the same company, but what do you notice here? The guaranteed crediting rate with this product is 1%, and we're also illustrating the maximum insurance expenses. So we're positive here. They paid in $5 million. They've got more than that on their balance sheet. There's the death benefit, but it's decreasing here. And eventually it goes in the red. Now we ran this example through age 50. Then we looked at another carrier here, which based on their current crediting rate and their current insurance expenses are much, much lower. Looks very attractive there. However, when you look at the guarantees, it's not attractive at all, not compared to the other example we saw. But again, this kind of stuff is beneficial to see up front. Now, looking at historical performance and what actually happens with the products and policies, that's very, very beneficial to see, and that really helps a potential buyer, a bank, refine their decision-making process. But at the same time, this stuff is valuable to see. I like to see it when I'm considering policy purchase for myself or when we're working with someone. Even though when we're working with someone on a whole life insurance policy, it is a different product, but it's the same approach when we're looking at how to maximize the cash value and then reviewing the non-guaranteed, guaranteed values, and then also historical, meaning real, actual performance. So the product itself, what is it? Is it a whole life insurance product? It is not. A BOLI policy is a single premium universal life insurance policy. And again, we've got that constant crediting rate when we look at an illustration with an increasing insurance expense. So how the cash value works is that it is an asset on the bank's balance sheet. We do see it appreciate over time. The bank does not plan to access the cash value as BOLI policies are modified endowment contracts. So it's a single premium MEC. It's a universal life insurance product, but a MEC is what? That modified endowment contract. If we access the cash value, what happens? You've got income tax doing the gains, a potential penalty tax. It's not being accessed, or it's very rare that banks do it. I have not seen a case, but that doesn't mean that it hasn't happened. The death benefit, paid income tax free to the beneficiary. The beneficiary is in most cases the bank. When it is not the bank, or I should say it's always the bank, but when you might see an additional beneficiary, is if a split dollar plan is set up. So a split dollar plan is sometimes offered to participating employees. And what we've seen is typically this 1x salary to the employee's beneficiaries. So for example, if you've got an employee, pretend you're the bank, you have a BOLI policy or multiple BOLI policies on them, a lot of times that's the case, and the total death benefit is $2 million, the beneficiary is the bank. Now, let's assume that that employee earns a salary of $125,000 per year. What you'll see with this split dollar arrangement is the bank will say, of that $2 million death benefit, Mr. or Mrs. Employee, $125,000 will be paid to a beneficiary of your choice. If you list it as your family member, an entity, whoever you decide to list the beneficiary as, that benefit is paid to them. If you remain with the bank as an employee, typically you will see that in there too. But that is a nice benefit there. Banks will make sure that they're still profitable or they are able to cover expenses. So a nice advantage to the death benefit and why it's attractive is a bank, like many businesses, has employee costs, such as health insurance benefits, 401k matches, and you can go on and on as far as the expenses associated with employees. So what that death benefit does, because it does flow back to the bank, income tax free, is it helps recover costs that they have spent on that employee over time. So there's a nice advantage there to the death benefit. But really, when we're working with a bank and looking at a purchase, really what's being examined here is the cash value. What's the growth look like over time? What's the carrier's financial ratings, their track record? What do the guaranteed values look like? Are those realistic? They've always done better, but it's still good to look at, especially if you like to look at things conservatively. But this is what the focus is again. So I hope you enjoyed this video. This is a topic I always like to talk about. If you are not a bank, because most of you watching this video probably do not own a bank, but if you do not, that is perfectly fine. It's always good to gather information to see what banks and institutions are doing. If you own a small business, it is possible to set up cash value life insurance products that will not look exactly like what we saw there. If we're using whole life insurance products that are designed for high cash value, the big difference will typically be that first year, where here we saw a positive cash value. With a traditional product, we might have anywhere between 80 and 90%. Sometimes it's a bit more. You can get a little above 90% sometimes in first year cash value. But that's, if it's 90% of what I paid into the policy in the first year, that's a 10% loss. So there's a difference there, but my point is we do try and mimic it as much as we can as far as having cash value as an asset on the balance sheet. But a big difference for business owners with whole life insurance products and the traditional approach, meaning a non-MEC, is that you do have more freedom to access the cash value, which is nice. But we've got other videos that provide full details and case studies on that. And I'm going to stop talking now, otherwise I'll go on and on. My point to mentioning that was there are ways you can still maximize a cash value life insurance policy for your business. So I hope you enjoyed this video. Please hit the like button and subscribe for more. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.